Hello, everybody. At this time, we are talking about profitability. Profitability is measure of a business profit relative to its expenses. In other words, it's an organization's ability to generate income by using resources that has available, such as people, time, and equipment. Profitability is the primary goal of all companies because it's the money that business ventures generate through their activities. It enables those ventures to grow, develop new products, or enter new markets. Profitability is a relative term that describes a company situation that generates profit. And then why understanding a company's profitability is important. At the end of the day, a business primary objective is to make money. The amount of money made after considering every avenue of earning and expenses is the profitability of the business. If a business is not profitable, it will not last. Even organizations that are extremely profitable and have bright futures are subject to failure if they cannot maintain profitable operations. Profitability is used when analyzing whether or not a business is a going concern and can continue to operate in its current capacity. The term going concern is a concept in accounting that is used to label businesses that have the resources required to operate indefinitely. It is a way to express whether a business has the ability to generate enough income to satisfy all expenses and service its debt obligation, especially. When a business is no longer a going concern, it has filed for bankruptcy or was forced to liquidate assets. Understanding your company's profitability is critical in assessing whether or not the product or service that is being sold is worth the effort. When starting a business, there should be some understanding of whether or not it will make money. As a business grows and matures, additional analysis should be performed on its profitability to determine the quality of its next income. And then we move to the internal factors influencing profitability. The first factors, cost management. Effective cost management strategies can lead to improved profitability. Companies that can reduce their operational costs while maintaining quality and efficiency are likely to see higher profit margins. And the second, operational efficiency. Streamlining operations and improving productivity can enhance profitability. Companies that invest in technology and process improvements often see better financial performance. And third, pricing strategy. The pricing strategy adopted by a company can directly affect its profitability. Setting prices too low can erode profit margins, while pricing too high may damage customers. Finding the right balance is crucial. And then fourth, product mix. The types of products or services offered can also affect profitability. High margin products can boost overall profitability, while low margin items may dilute profit margins. And then we move to profitability calculations. The company's profit is shown on the income statement. Profitability is not shown on the report but uses the values on the reports to calculate. The profit amount is used to calculate the profit margin or gross margin. These two profitability ratios measure how well a company is utilizing its resources in generating profit. The income statement will always show the net income at the end of the report. The net income of the amount of income, especially in a period after all expenses have been deducted. This profit amount cannot be used on its own. A company should do a profitability analysis to understand how efficiently a company is using its resources and capitals. And then we move to the formula of profitability. There are several formulas or measures that are commonly used in the financial market to measure the business profitability. The first is gross profit margin. This can measure the percentage of revenue that is over and above the cost of goods sold, or COGS. It is calculated by deducting the COGS from the revenue earned, and then the result is divided by the total revenue and multiplied by 100 to get the value as a percentage. And then second, operating profit margin. This shows the percentage of revenue that is left after subtracting both COGS and operating expenses. It gives an understanding regarding the efficiency level of the business in running and managing the daily operations. And then third, net profit margin. It represents the profit that is earned by the company after meeting all its expenses, including interest and taxes. And then fourth, return on equity, or ROE. This matrix evaluates the profit earning capacity of an organization in relation to the shareholders' equity. And then fifth, return on investment, or ROI. In this metric, the gain or loss of an investment is compared. It is to compare to the cost of the investment and evaluate the profit earning capacity of the business. Finally, we move to the advantages of profitability. The first advantage about it provides you with information about how an investment changes the value of a firm. Second, it is an investment tool that is easy to understand. Third, it will take into consideration all cash flows from a project. Fourth, it will give you information about ranking making projects while still rationing capital. Fifth, it will take the time value of money into consideration in the calculation. And sixth, it considers the risks which are involved with future cash flow. I think it is enough. Thanks for watching.